Hello, today's video is part 2 of 3 on the topic of securities lending indemnifications, the final layer of protection for many investors that lend their securities. Over the series, I look at what they are, when they come into effect, question if they provide real protection, and examine why some people say they need to be reformed, and maybe even question whether they're needed at all. So if securities lending is your thing, if you are a borrower, a lender, an intermediary, a vendor, an advisor, or just plain interested, then this is the place for you. So let's get started. Hello everyone, I'm Roy Zimmerhansl and welcome to another episode of the fundamentals of securities lending. Today I'm going to be looking at market activity, trends and profitability, and an example of a default with multiple scenarios. And in the next video, I'll put all of it together and talk more in depth on indemnifications. Now, this is the second of 3 videos on the topic, so if you haven't seen it yet, I recommend that you pause this video and go to part 1, which you can see in the link on the screen or in the description. Now, in the first video, I looked at what an indemnity is, what they do and don't cover, how agent lenders provide indemnities, and why each one is unique and needs to be understood individually. In this video, I'm going to address why we should care, give you examples of the firms that defaulted or were near default, work through an example of the transaction economics, including a sample default, and I'll start with today, right now, why indemnifications are a potential roadblock for future growth. Now, the inspiration for the review was a recent paper from Mark Faulkner, co-founder of Credit Benchmark, entitled "Something Better Changed, Securities Lending Indemnification is Unsustainable in its Current Form." There's a link to Mark's paper in the description, and I encourage you to read it. So, why should we care? Well, for better or worse, indemnities seem to be inextricably linked with securities lending, and it's still wrapped up in the typical agent-lender offering to existing and potential lenders. And there's no doubt that it uses scarce resources at the agent bank level, capital reserves and single counterparty credit limits, for example. And where resources are used, they need to be paid for. And the question is whether investors are compensating the indemnity providers. And if they're not, what's the impact that that could have? Remember, this comes after several years of investments by agents conducting business in Europe to satisfy the needs of the Securities Finance Transactions Reporting Regulation, and potentially more investment that'll be needed to satisfy the proposed SEC regulations to improve transparency of securities lending. For those of you that don't know, the SFTR obligations belong to the investor whose securities are being loaned out, not the agent. So again, agents have invested in providing a service for customers that outsource the reporting obligations to the agent. But my guess is that few, if any, of those investors pay the agents to do that work for them day in, day out. Now, the headline figures for the business overall looks really good, but I've been going on about the need to improve the cost dynamics of the business for years because I believe that we need to do everything we can to remove barriers to entry. That will encourage new users of borrowed securities and maintain sustainability for the business. Now, let me take a couple of minutes to review the scale of the business. In this first graph from the ISLA Securities Lending Market Report as at the end of 2021, you'll see that the on-loan balance has grown since they started producing these reports at the end of 2014. And they've grown roughly from 1.6 trillion euro to 2.7 trillion euro, and that is growth of about 70%. Pretty good, right? But if you look at the MSCI World Index futures for that same period in the second graph, you can see that the overall market value went up about 85% over that same period. So, in other words, market values went up over 85%, while securities lending on loan values only increased 70%. Now, of course, that's a pretty far cry from an exact comparison, but it does give you an idea of the direction of travel. Fortunately, given the 2 snapshot dates of end 2014 and end 2021, the dollar-euro exchange rates don't really have a big impact on those figures. The next chart shows revenues for the period 2014 to 2017, taken from the IHS Markit Securities Finance Quarterly Review Q4 2017. Now, I'm going to pluck out 2014 and say that the revenues were about $8.3 billion, meaning that securities loans returned just over 50 basis points per dollar on loan. By the end of 2021, that had shrunk to just under 34 basis points, more than a 30% drop. Now, whatever the reasons, the value on loan has gone up, and so the cost of providing indemnifications for those increased balances has gone up as well. Now, the increasing balances are backed by capital reserves for agent banks, so if balances are going up and revenues per unit on loan are decreasing, it hits profitability. And at the same time, the supply of assets available for loan has increased to 32 trillion euro at the end of 2021, according to ISLA. In other words, more investors are lending today than ever before, having risen from 12.5 trillion at the end of 2014. While demand for borrowing has gone up, supply has increased over 250%. Now, this long-term secular decline in profitability of securities lending intermediaries is due to a combination of factors: regulatory, supply-demand issues, and of course competitive pressures. So you have to expect that at some stage there'll be a breaking point. Now, arguably, the lack of interest from so many agents in supporting low-margin, higher-volume, widely available securities called general collateral, or GC in securities lending parlance, I think that's a clear demonstration that the cost dynamics of the business is affecting their behavior. Now, the impact on investors, of course, is that they lend less and generate lower overall incomes. Remember, GC securities probably make up the majority of every institutional investor's portfolio. So I think it's right to question whether this sort of situation is sustainable, as it might impact the majority of portfolios for the majority of institutional investors. Now, before I get back to indemnities, I need to remind everyone that securities lending activity doesn't represent the full spectrum of short interest. So during that same period, the volume of synthetic derivative structures has grown dramatically, and I think it's likely that overall short interest has increased in real terms over that period. It's just that synthetics have various cost benefits over securities lending, so unless something changes in securities lending, I expect that trend direction to synthetics to continue. Now, back to indemnities. A recap: indemnities are part of the waterfall of protections that lending investors typically get from their agents. The first level is that lenders can choose which securities from which portfolios they lend out. Then they can select which borrowers they're willing to lend to, and even apply exposure caps if they like. Third, they can choose which forms of collateral they like and accept, and how much excess collateral they want. Once lending has started, and every day thereafter, the loans and collateral are revalued and the collateral is adjusted to make sure that the client's excess is maintained. So look, that's a lot of protection in the event that a borrower goes bust. And if the borrower does, then the agent sells the collateral and makes the lender whole, depending on what the indemnification covers. I'd recommend you look back at the first indemnification video to understand more about what indemnities do and don't cover. How often do firms in this business go bust? I think that's a great question. Now, the diagram that I'm showing you now gives you examples of some borrowers and lenders that have either gone into default or nearly gone into default and had to be rescued. So this isn't an exhaustive list, just the highest profile firms that I can recall. You can see that while it's not commonplace, it still does happen from time to time. Now, clearly the potential for drawing out an indemnity is real, but nevertheless you need to remember that the only time an indemnity will be drawn is, number one, if a borrower has gone into default. Now, since the investor will undoubtedly have exposure to multiple borrowers, that diversification in itself is a protection, because the exposure to the one defaulting entity will be only a proportion of the overall loan. So that's one condition. Second, before an indemnity kicks in, the collateral sale proceeds have to be insufficient to cover whatever entitlements the agent has committed to provide. Now, remember that the lender is also over-collateralized by 2%, 5%, 10%, or even more, depending on a combination of factors. And the collateral, as I mentioned earlier, is marked and settled on a daily basis. So In the event of a default, it's the absolute amount of the investor compensation versus the collateral proceeds. In other words, if the collateral proceeds drop by 10% because the market's fallen on the day of that entity's default, it's very likely that the cost of buying back the loaned assets has also dropped by a similar figure. You know, as the saying goes, markets take the stairs up and the elevator down. You know, if you have a basket of equities on loan versus a basket of equities as collateral, it's pretty reasonable to expect that both will fall if a financial institution goes into default. And so the value of your collateral might drop, but the cost of replacing the loaned assets will fall as well. Now, sometimes where an investor is lending government bonds and getting equities as collateral, what they usually require is a higher degree of over-collateralization. So that mitigates the risk of adverse relative price movements in that kind of a defaulting entity scenario. And although there have been losses related to securities lending, it's almost always tied to losses incurred as part of the result of investment of cash collateral, which goes wrong for one of many reasons. Investments that have failed to deliver the payout that they expected, early disposals in difficult markets, or even inappropriate investments. And I'm not aware of any instances where an indemnity has actually come into play, but it may have happened. But let's say it does. The important thing to remember here is that the indemnity is only needed for the shortfall, not the total amount. The full value of the excess collateral has to be exhausted before the first dollar of indemnity exposure starts to accrue. So let's work through an example. First, the base case in a default. I've started with the ISLA stats of 32 trillion available for loan at the end of 2021, with 2.7 trillion euro on loan, giving a utilization of 8.4%. So hypothetically, an investor has 100 million euro of securities on loans spread across 15 borrowers. Now that suggests their overall portfolio is worth roughly about 1.2 billion euro. And the base case itself is, let's say their third largest borrower goes into default while having borrowed 20 million from the investor. And of course, they'd be providing 21 million of collateral, in excess of 5%. Now, the day Lehman went into default, the Dow Jones fell 4.5%. And in this example, both the loaned assets and the collateral fall 4.5%. So the excess collateral position of 5% is still maintained, and the excess, if there was any, after making the investor whole, would go back to the defaulting entity's liquidator. In the next example, though, the loaned assets only fall 2% while the collateral falls 6%. That's a net shift of 4% against the investor, but they still end up with an excess collateral position of 1%. In the third example, somehow the loaned assets in total dodged the market falls and kept their value, while the collateral assets only, they performed worse than the Dow did on the day that Lehman defaulted and fell in total by 6%. Now this leaves the investor with a shortfall of 260,000, and an indemnity would kick in. But look, I need to add that an investor with about 100 million on loan could be expected to generate a return in fees of over 300,000 euros. So even without an indemnification, the investor would be better off having loan securities than not lending, even in that last worst case unrealistic scenario. So even in this case, in this scenario, securities lending has been accretive to the portfolio. And that investor, though, is probably going to have suffered losses in their investment portfolio itself, irrespective of whether they did lending or not. Remember that markets go down as well as up. It's reasonable, therefore, to raise the question whether investors really even require an indemnification. Then, if they decide they want one, what should they pay for this extra, potentially unnecessary protection, and whether it's time for a change, as Mark Faulkner suggests. And that's exactly what I'll be looking at in the next video. So that's it for me for another video. I hope you found this useful and informative. I'm Roy Zimmerhansl. I'm your host. I hope you have a great week, a great weekend, and I look forward to seeing you next time.